What's up guys, Raymond here with episode 8 of our financial statement analysis videos for these German industrial stocks. And if you're new to my financial statement analysis videos, what we do is we analyze the top 3 financial statements which are relevant to a company that depicts the company's financials in the past 3 financial years, those being the income statement, the balance sheet and the cash flow statement. We also look at the key factors of each statement and attempt to get an overall picture of how strong the company is based on in accordance to its stock price fluctuations, and we attempt to get an idea of how well the company will do in the future, whether it will do well or whether it will do poorly. So without further ado, let's get into the key ratios and then we'll get into the 3 financial statements. So the market cap, which is the overall price of the company, if somebody wanted to purchase the entire company, it would cost 1.69 billion euros. The revenue figure, which is the overall sales of the company in one financial year, which in this case is 2021, was 3.54 billion euros. The price to earnings ratio is just a representative figure of how many years it will take for you to get back your initial investment if you were to invest. All things considered, that the stock price moves at a steady growth rate, adjusted for inflation, and the company manages to maintain its economic output adjusted for inflation. So the revenue figure was, as we said earlier, was 3.54 billion euros. The dividend yield was quite small at 2.05%. The beta level, which is the overall risk level of the stock, was 1.59, and the earnings per share was 1.41 euros. So let's get into the income statement. The income statement shows that the company doesn't really do well in generating net income or cash from operations, so that's definitely something that the company could do well or do better to work on. The balance sheet shows the total liabilities of a company as a ratio to the total assets, which is the light purple figure. It's always good, I say, to have a debt to asset ratio at a maximum of 50 or 60%. 60% should be only used by companies that are very well established, that have trust with the financial institution that they attempted to borrow money from. But 50%, I would believe, is a safe margin to have as a debt tax ratio. As you can see in this case, the company Duerr that we're analyzing hasn't managed to maintain a 50% debt to asset ratio. It's generally gone quite above it. I would say around 8% debt to asset ratio, which is quite dangerous because it exposes the company to increased levels of liquidity risk, as well as a capital, just general financial risk. Let's look at the cash flow statement, which is the last of our financial statements, and see how the company manages cash. So the net income is the starting line, 132.56 billion euros for the 2021 financial year, negative 18.54 million euros in the 2020 financial year, and 174.72 million euros in the 2019 financial year. So the company is doing progressively worse, I believe. Not consistently progressively worse, but the 2021 financial year and 2020 financial year were not as great as the 2019 financial year with regards to overall economic output. But we're going to get into the cash flow from investment activities, which is broken up into 78 million euros spent on capital expenditures, so the company can be more productive in the future. Cash flow from financing activities, which is total dividends paid, was 20 million to shareholders, and 278 million euros was used to eliminate debt, which is good on the company. Net change in cash was negative 186 million euros, which is fine. It's not always negatively a bad thing if the company has a negative net change in cash. It just either means that the company's spent more cash than it has on hand on expanding property, plant and equipment, or for some other reasons. But yeah, without further ado, I want to close this video. Thank you guys for watching. I will see you in the next one. Peace.